Hi, and welcome to Macro Matters. My name is Stephanie Kelly, and together with my co-host Paul Diggle, this podcast will guide you through the world of economics, politics, policy, and investments. And today we're dealing with a topic that's increasingly on the minds of newspapers, of policymakers, and of investors, and that's the thorny issue of climate change.
The ice shelves in Antarctica have melted to such an extent that since the mid-1990s, they've produced enough water to fill the Grand Canyon.
This is just the very beginning.
The Amazon rainforest to California, human activity is raising temperatures and adding to the threat.
China would be carbon neutral by 2060.
Climate change is the number one priority.
It's the number one issue facing humanity.
If we act now, we can yet put it right.
There we heard a number of high-profile politicians and climate advocates talking about climate change as the number one challenge facing the world. But are those words really matched by policy action? And how should investors think about the potential impacts that climate policy and climate change might have on their portfolios? Well, joining us today to talk about just that, I'm delighted that we have Jeremy Lawson, our Head of Research Institute here at Aberdeen Standard. We'll also be joined later on by Craig McKenzie, Head of Strategic Asset Allocation, to talk about how he thinks about climate when investing for the long term. But first up, Jeremy's here to give us a bit of a climate change 101. Why does it matter for the global economy and investors? And it's worth knowing that before joining finance, Jeremy has extensive experience working on climate policy, climate economics, and including designing the Australian Labor Party's environmental policy under Kevin Rudd. So who better to kick us off? Thank you, Jeremy, for joining us.
My pleasure. Thanks for having me, Steph.
So I thought we could kind of kick off just by introducing the topic of climate change. I know it's something that's in the news quite a lot, but when we think about it from the perspective of the global economy and markets, what are the kinds of risks that climate change and climate policy pose in that kind of context?
Yeah, it's so let's sort of split those two things. Let's first focus on climate change itself. So climate change is leading already to very significant changes in the climate system. Whether that be related to not just sort of increases in average temperatures, but in some cases much larger increases at, for example, at the poles, right? So the Arctic has warmed by twice as much as the equator has warmed over the last 100 years, just as an example. It can lead to things like more regular cyclones, more intense cyclones, changes in rainfall patterns, changes in the intensity of fire seasons and their longevity. So there's very little aspect of the climate that we live within that is untouched by climate change. And if emissions continue to rise unabated, that we've really just touched the surface of the type of physical changes that we can expect, and the political consequences that would derive from that. And so even though climate change, it's slow moving in the sense of, for example, the world has sort of been warming at about a 0.1 degree average per decade. So that can feel really small in the context of the fluctuations that we see in the temperature on a day-to-day basis. And obviously through the seasons. But when you stretch your horizon, those small incremental average changes and the other climactic impacts, they can have really profound implications on the climate that we interact with, and therefore then the economic infrastructure that's been built around a particular set of climate conditions, whether that be patterns of housing development, the locations of critical pieces of infrastructure. So physical climate change has the potential to touch everything, even if most of the worst impacts are likely to take place over the longer term. So that is really then a question of, well, how much do we care about future generations when we're setting policy today, right? Many of us might actually die before the worst manifestations are obvious. But if we care about future generations and their economic welfare and their broader welfare, then we have to care about climate change today. So that's that side. And then when we think about the opposite type of risk, which we call transition risk. So this is the idea of the policy changes that we make today that are designed to ultimately prevent those physical climate changes from happening in the future, or at least limit the further increases, particularly with the way that we mitigate or reduce greenhouse gas emissions across all the major emitting sectors of the economy. And that's quite different. So first of all, in order to prevent those future climate changes, then you need to start changing policy today. So transition risk by its nature, can have an impact on economic activity and financial activity over much sort of shorter term timeframes. But maybe the other way to help people think about it is to think about the way that since the Industrial Revolution, the energy usage in the global economy has increased in lockstep with global economic activity itself, right? So we have a global economy that is highly dependent on energy usage and fossil fuel usage in particular, right? So the global economy, the modern economy, was built on the use of coal. It was built on the use of oil. It's increasingly being built on the use of natural gas. And so the really big challenge, if we care about climate change, is to effectively decarbonize the energy system. But that is a really difficult thing to do, right? It requires, nothing short of a revolution in technology and the way that we use different types of energy. And that change, given the way that particular types of energy are embedded in existing infrastructure, existing usage patterns, in the price of assets, that can have a really profound impact on economic and financial outcomes.
I think that's a super useful and really, I think, quite in-depth assessment of both the kind of physical and the climate policy risks. Maybe we stick with the climate policy side of things for a while, because you said there, really what's required is revolution, and we'd expect that legislation and regulation will have a key role to play. And a lot is made of the Paris Agreement and, kind of very visible commitments that country governments have made to reduce emissions by X% by this date. I mean, to what extent, though, should we, investors, should they be questioning those kinds of commitments? What do you actually think is happening on the ground in terms of climate policy?
Yeah, so maybe to take a step back, just so people understand why policy is so important. Climate change is a perfect example of what we call in economics an externality, right? So that's the idea that, so if I'm a polluter, the impact of that pollution activity, the costs of that are borne not by myself primarily, but primarily by the planet and other economic agents, right? And so I don't internalize those impacts in my own decisions unless I'm incentivized to do so. This is why nearly any economist that has approached the question of how do we sort of prevent climate change, they come back to this sense of how does policy change the incentive structure? How does it price that externality so that those impacts are taken into account and so that we can decarbonize the economy as quickly as we need to? Now, part of the problem, I think, with the nature of the debate and discussion that occurs is as you were alluding to, we get these big set piece events, right? So the Kyoto Protocol, the Paris Agreement, where governments sort of get together and they say, yes, we agree that this is a really serious problem and we need to confront it. And then what they do is they commit to numerical targets or objectives. So we want to limit climate change to well below 2 degrees and ideally to 1.5 degrees. We're going to commit to to constraining emission or to reaching net zero emissions. So the idea that you are taking as much carbon out of the atmosphere as you're putting into it by 2050, right? And so a lot of the news that people see is all in the context of these big headline commitments. The problem is that if those commitments are not backed by credible policy change that significantly influences the incentive structure to pollute, that prices carbon, right, that encourages technological development, then the probability of those high-level objectives being met are relatively limited. So when we're thinking about transition risk and what does it mean for economies and markets, and Stephanie, this is something that, you and I have done a lot together in our research already and doing more in the future, we have to think really carefully about the political economy and the credibility of those commitments. So are these mechanisms binding, right? Is there a carbon budget, that there is a legislative mechanism that sort of ensures that it will be met? Are carbon prices rising as quickly as they need to achieve those abatement outcomes? Are you getting international cooperation such that actions that take place in Europe just don't lead to carbon leakage into emerging economies? All these questions are absolutely vital when we're trying to think about, well, what is the probability of these high-level objectives being met? And too often, I think, in this discussion, not enough weight is given to the detail of what underpins these commitments, right? There's too much focus on the headlines, and as such, there's a tendency to be disappointed over time. So it's already the case that just 5 years after the original Paris Agreement, very few countries, certainly before the COVID crisis, were on track to meet the very modest commitments that many of them were making as part of that agreement, right? And this is a story that is told over and over again. So we have to think about the detail, not just the headlines.
I think that's quite a strong sense of just how challenging this is. And as you say, the political economy of this matters maybe much more in reality than what countries are saying that they're going to do in kind of headline terms. I guess my natural question is, do you think, because net zero is something that comes up a lot, and obviously it's part of the investor agenda, but when countries are committing to net zero, are there any places in the world that are likely to meet net zero targets by 2050?
Look, it's very difficult to make confident long-term projections over a 30-year period. But again, if we use that framework of, where is policy most credible, where is there political alignment such that nearly all actors in this space are pushing in the same direction, the region where this is most likely is Europe, and I'll include the United Kingdom in that because it's sort of its policy commitments and the framework, at least up until Brexit, is very much within that European framework. So that would be the place where it's more likely than others. But even then, I wouldn't say that it is by any means certain, right? So net zero is not enshrined within the European emissions trading scheme at the moment, right? So until that's the case, then you wouldn't be able to say that commitment, has that type of credibility. Secondarily, the European emissions trading scheme only covers 50% of aggregate European emissions, and a lot of the emissions that are hardest to abate in the industrial sector, in parts of the transportation sector, in the building sector, in the agriculture sector, they're not included in the emissions trading scheme, which then means that you need other initiatives to control those emissions, but they can be more difficult to do so. Elsewhere, it's really sort of hard to see that coming together at the moment. There need to be some quite radical changes in policy to feel confident about that. Again, we've talked, Stephanie, about the United States, and it certainly would have been the case, and look, it's still possible that you could get a majority, a Democrat majority in the Senate that allows President Biden to pursue a more aggressive agenda. But if Republicans continue to control the Senate, there is no prospect of really meaningful new climate-related legislation in the United States over the next 4 years, right? So at least the next 2 years until we get just beyond the next set of midterm elections. Well, that matters a lot because whilst yes, there's freedom within existing US regulations through the Environment sort of Protection Agency and other mechanisms to try and sort of mitigate emissions and to use the Clean Air Act to do so and things. Those sort of things, it's also it's constrained in how far you can push that. And so, this matters a lot. The United States is the world's sort of second largest emitter. The world cannot get to net zero if the United States doesn't get to net zero. It's just not credible. Now, make a really important point here. We're not saying that I'm not questioning the idea that there's going to be an energy transition. There is already an energy transition underway. If you look at the growth rate of renewable technologies, wind, solar across many economies, starting to see sort of gradual increases in electrical vehicle penetration, the relative price of renewable technologies coming down. There is real progress, and we are expecting meaningful change over the next 5, 10, 20, 30 years. But just because there's change taking place, an energy transition occurring, that doesn't mean that it'll be complete on the time frame that is commonly thought about. That's likely to be much patchier.
Yeah, absolutely. I mean, I think the point with the US is I kind of think it might look like there's a lot happening in kind of the clean energy space in the US because of the president's ability to do kind of regulatory changes. But to me, a lot of it is going to be just reversing the kind of unpicking that went on during the Trump administration of previous environmental protections that were unpicked over the last 4 years that then have to be re-sown now. So really you're kind of running to stand still at that point, in spite of maybe what the headlines are going to show. And I think this is where...
No, I was just going to say, I think you're exactly right. And this takes time, right? You don't just wake up one day and reverse the rules that were put in place over the previous sort of 2 to 4 years, right? It can take up to a year to reverse all of those changes. And then, of course, you have to take into account, the changes in the composition of the courts, right? So there is we'll call it a conservative majority in the Supreme Court of 6-3, right? There are going to be a lot of cases that come up in the Supreme Court over the next few years testing the regulatory limits, of the government, where there are a lot of incentives for those interests that would seek to prevent a significant amount of abatement, where they'll be sort of looking to get support from the courts and to undermine the changes that the Biden administration might make. And so yes, I think it's really important to have a very clear sense of what is possible and probable, and not just sort of focus on, for example, when Biden rejoins the Paris Agreement, right? So yes, that'll be a good thing. We need the United States engaged, but just because that's occurred doesn't mean that all of a sudden you're on the right pathway in the US.
Yeah, absolutely. And then, I mean, gosh, we could go country to country, and I think it's quite striking when you do just how much variation there is in terms of commitment, ability to kind of implement, etc. But I'm conscious that really what we want to get onto is talking about how can investors think about all this super complicated climate policy considerations, technological innovations, changes to the market environment. And I know that you've been central to a piece of work that is going on at Aberdeen Standard to build climate scenarios. So this is emerging as kind of the industry standard to build climate scenarios. So maybe before we go into what you've kind of specifically done, what is the kind of point of having these climate scenarios? How do they work?
I think it's pretty simple. What you're doing is you're saying, here are the different ways in which different types of climate risk manifest themselves: physical climate change, transitional risk, and we need to understand the financial implications of them in order to make sort of appropriate investment decisions in any area, where those sort of risks are likely to be manifest, right? So how could you invest, for example, in the automotive industry at the moment without having a clear sense of what you're expecting for electrical vehicle penetration over the next 10 years or 30 years, and which companies companies are likely to be the winners and losers. So I think the easiest way to explain climate scenario analysis is to say how we cannot make good investment decisions without understanding how different types of climate impact, from the very probable to even the tail risks, might sort of influence things, and have a very clear framework of bringing all of that together.
Right. I think that's super clear. And so, dare I ask, how many scenarios, when you were building the scenarios, how many did you incorporate?
So we currently have 14 climate scenarios in our exercise. Now, that might seem like a lot, but about half of those scenarios are what are called off-the-shelf scenarios. So these are things that, for example, assume current policy, right? So there's no change in climate policy in any sector or any country over the next 30 years relative to what we are today. Well, you can take that scenario off the shelf, right? You don't have to do any really complicated design work. And it's important to have that as a benchmark. It's important to have that for physical climate risk to compare it with other people are doing, right? And then on the other extreme, you have the same thing. So a 1.5 degree scenario where global policy action starts in 2030. Now, we don't think that that is a very likely scenario, but we need to understand its consequences, not just in case it does occur, but more importantly, because a lot of stress tests that regulators are asking people like ourselves, insurers, pension companies to undertake, they investigate the impacts of those stresses. And so we need to be able to do that exercise ourselves to demonstrate that we understand them. But most of our scenarios, and the ones we put the highest weight on, are what we call bespoke scenarios. And so what we've done here, again, I'll try and keep it very simple, is to say, so if the audience thinks about climate policy in Europe and the United States, right, and all the discussion we've just had, and China as well. So think about those three countries and regions. I don't think there's anybody who would say that they expected climate policy to be identical in the US, Europe, and China over the next 30 years. Everybody would be expecting different implementation, different speeds of action. Now, if I then told you that most of the climate scenario field is built around the assumption of identical policy implementation, both in terms of objectives, across countries and across sectors, you'd look at that and then the reality of what we see and you say, well, that seems weird. How are we going to understand climate risk if we're making a really silly assumption like universality? And so
Definitely.
Really a lot of our scenario work is saying, no, look, we need to take that likely dispersion of policy and technology sort of quite seriously. We need to understand what the consequences of that are, because we can't figure out how assets should be priced and what the risk distribution around that looks like unless we have a really sort of fine understanding. And so our work is sort of predicated on building scenarios that allow us to really investigate how different plausible variations in that complex, messy world of policy and uncertainty about future technology pathways, what that might mean for economies and markets.
Fantastic. I think that's a super clear sense of the benefit of the scenarios. And I know Craig is going to specifically talk to us about how he's going to apply the scenarios in his kind of long-term investing, but more broadly, how do you expect these scenarios to impact investment decision making?
Yeah, so we're in some very sort of deep dialogue with the investment teams within the company at the moment, to sort of say, okay, so this gives us a good foundation for understanding really important elements of climate risk. So how do we best make sure that you've got the type of information so that you can make good, improve on your decisions as well? Now, I'll be really clear about this. In most cases, this will not be there's nothing mechanistic, right? These are still stylized projections about how these sort of things should be priced or might evolve over the long period of time. But there's all sorts of factors that it can't take into account. A really good example is transition companies, right? So you can identify a company that looks really vulnerable to transition risk. But if that company is doing the right thing, it already knows that it's vulnerable to transition risk and will have a business strategy to confront it. But a climate model can't know know that change in
Right.
business strategy is coming. And so this is the importance of combining this research with stock-specific research and analysis so that we could sort of think about all of these issues together. But so it's going to anyway. So through these mechanisms, it will sort of be one of the factors that stock experts, portfolio constructors, researchers take into account. We'll be using it in our stewardship process, the way that we engage with companies as we assess, well, are you taking this seriously? Do you understand the risks that your business faces? And then increasingly into solutions, and you'll get more onto this with Craig, that allow us to say, well, okay, so if you're a client and you want to, and you want an option in fixed income or in equities or multi-asset that is consistent with the objectives of the Paris Agreement, how do we build you a solution, right, an option that allows you to meet your financial objectives and sort of consistent with those broader climate and social objectives. So there's a whole host of ways that we're sort of taking this into account within the firm, and very seriously.
Great. Thank you so much, Jeremy, for your comments there. I think that's given us a really good sense of precisely what the nature of the climate change challenge is for investors and also for the global economy. And this is the perfect time, I think, to segue into our next guest, who's Craig McKenzie, our head of strategic asset allocation, who's been deeply involved in developing these climate scenarios as well, and clearly has a clear utilization for them in his own investment process. So super excited to dig into that a little bit. And thank you so much, Craig, for joining us.
Glad to be here, Stephanie.
So maybe we could just start off by asking the question of, where is the demand for understanding climate in an investment environment? Where are you finding it's coming from? Where are the pressure points? Is this internal? Is it external? Is it clients? Is it is it a mix? I mean, where are you finding that this kind of demand has really been driven from?
So in my role, I do strategic asset allocation. So it's about long-term investment returns, helping big institutional clients build portfolios for long term. We're seeing a huge amount of interest in climate as a topic. And broadly, I think it's coming from two different perspectives. One is a risk perspective. So lots of big investors have committed themselves to reporting against the TCFD, the Task Force for Climate-Related Financial Disclosures. So they need to kind of understand how the climate transition in particular, but also physical risks, will impact their portfolios over the next 10 years. We're also seeing interest from regulators. So the Bank of England Prudential Regulation Authority now requires all banks and insurers in the UK to use climate scenarios to stress test their portfolios. And there are similar regulations in France. Singapore, the Singapore regulator is looking at something along these lines. Pension funds are now being required to produce reports on their ESG risk, and climate is one of the kind of top ESG risks. So that's one big category of demand for climate scenarios. The other one is a bit different. It's this sort of net zero investing idea. So you'll be familiar with governments like the UK government saying we're committed to achieving net zero for the UK economy by 2050. Well, a number of big investors, including our biggest client, Phoenix, have decided to commit to getting their portfolios to net zero by 2050. And the reason why climate scenarios are so important for that is if you're going to start changing your investment portfolio to achieve a kind of climate goal, you need to come up with a view about whether that is going to impact the returns of the portfolio. And climate scenarios are one way of assessing that. So it's those kind of twin goals, trying to pursue a climate objective, reducing carbon emissions. Is that going to impact your portfolio? or trying to pursue your standard investment objectives and saying, well, is climate going to affect investment risk?
So I think it's a pretty, I guess, a pretty powerful driver, right? Having both the kind of the positive driver of that kind of pursuit of net zero and the importance for our strategic clients, but also then the regulatory realities around kind of climate risk. So when you then look at your portfolio, how will you use the climate scenarios that obviously Jeremy talked through quite a lot? How are you going to use those to inform or, you know, to affect the way that you invest in your kind of longer term portfolios? Because it is long-term investing that you do in particular.
Yeah. So there are 2 or 3 different ways we're using climate scenarios. The most straightforward is kind of probably the single biggest thing I do in my SAA job is generate long-term forecasts for expected returns. So when we advise clients on the best mix of US equities, emerging market equities, government bonds, credit, real estate, infrastructure, etc. For each of those asset classes, we generate a forecast for expected returns. So my global equities forecast today is around 7% per annum over the next 10 years. But for government bonds, it's less than 1% per annum. And that's actually an unusually big gap to do with the very low yields we have in government bonds today. So when I do all those expected returns, I need to ask the question, well, will the climate transition impact the expected returns? If I have an asset class like emerging market equities, which is quite exposed to carbon intensive utility companies in emerging economies, will the climate transition hurt the returns on emerging market equities? If, on the other hand, I have a kind of exposure to European equities and there are lots of renewable energy companies in that index, will that index outperform my standard forecast? So we've worked to use the scenario tools that we've been building, and in particular, one of the things Jeremy's talked about is the probability weighted scenario. And in my world of SAA, we spend a lot of time trying to work out what the probability weighted mean across scenarios. That I mentioned expected returns, that the term expected is the statistical sense of the word expected, where you mean the probability weighted mean across scenarios. So the fact that we've got a probability weighted climate scenario is really important because we can take that scenario and say, well, what would be the impact on returns for different regional equities, for different credit assets, and also for kind of climate enhanced assets. If I wanted to build a thematic portfolio of climate solutions companies, how might that perform relative to a standard equity portfolio? So that's the kind of thing we're trying to do.
So it sounds like there's quite a lot of different ways that you can kind of utilize it. I'm interested, I mean, have you gotten results already from the climate scenarios in terms of like what kind of stage of integration are you at with your portfolios and these climate scenarios?
Yeah, so we have already got some data and we've already started using it with some clients. So one of the conclusions, which may be surprising, is that at the aggregate level, so if you're taking, say, the S&P 500 or the FTSE 100 or the MSCI World Index, the impact of the climate transition is pretty tiny. And that is because, essentially, the climate winners offset the climate losers. So if you go down a level, but below the level of the overall aggregate index, you see really quite substantial changes. So the oil and gas companies get really quite significantly negatively affected with sort of -1%, -2% per year off the returns we would otherwise forecast. But if you, on the other hand, if you go for sort of electric vehicles or renewable energy companies, you get +3 or 4% per annum on the expected returns. So at the sector level, there are big differences, big winners, big losers. And at the company level, there are even bigger winners and losers. So but when you kind of put all those together, the negatives for the oil and gas companies and the coal utilities are outweighed by the electric vehicles and the wind and solar. So in aggregate, you get a pretty muted impact. So one of the things that says to us is, if you're one message is, if you've got a regulator saying do your stress testing on climate risk, the message we can send is pretty reassuring. It's that actually at the moment, for most of your standard equity and credit portfolios, you won't have big negative risk exposure. It's really you need pretty extreme scenarios to get those aggregate indices to have big exposures. So that's one reassuring message. But there are more interesting kind of stories, I suppose, if you see the climate transition as an opportunity. So if you're a pension fund and you've decided, right, we want to be net zero, we want to start shifting our portfolio away from fossil fuels and the climate laggards towards the leaders, how much will that hurt or help my portfolio? Well, our climate data says it will help it quite a lot. If you move away from a sort of standard aggregate benchmark, and you adopt a tilted aggregate benchmark where you go underweight to the fossil fuels and overweight to climate solutions, the climate scenario data we have suggests that will deliver some outperformance. And if you want to go even further and invest in focused portfolios of climate winners, then you can really get some quite significant outperformance. So that is a really powerful message for clients who want to move faster towards climate opportunities.
That is super, super interesting, that kind of the difference between the aggregate, just pure risk, and then actually the opportunities, which I think sometimes the conversation among investors can be very much about that kind of transition risk to your existing portfolio. And that kind of opportunities sometimes I think is a little underplayed. Is it fair to assume that, when you talk about having probability weighted scenarios, does that mean, given, what Jeremy talked about and some of the more, I guess, some skepticism we might have about government policy in some versions of kind of those scenarios, does that mean that you kind of are almost looking at this as being like, we are even a little bit more, maybe, how would I put it, a little bit less optimistic about the overall probability of a very aggressive path, and there are still opportunities? Is that the right way to interpret the fact that you're using a probability weighted scenario, or no?
Yeah, I mean, so one of the nice things about the tools that we've built is that we have the probability weighted scenario, but we also have all the individual scenarios. So I'm able to take our numbers. So sorry, I'm able to take our forecast for returns for different asset classes and run them both for the probability weighted one, which I've been discussing, but I can also run them for the 3-degree scenario, the 2.5-degree scenario, the 1.5-degree scenario, and I can see what the impacts of the full range of different climate scenarios are on returns. And so when I go to as I've said, Phoenix, our big insurance client, is committed to net zero, and they're very interested to start exploring the implications of that for their portfolios. So I can take one of these tilted benchmarks and I can run it in the probability weighted scenario, and as I've said that the story is positive. But then I can run it in the other 14 scenarios that we have, the individual scenarios. And what we find is that in around kind of 11 of the 14 scenarios, the climate enhanced benchmark outperforms the standard benchmark. It's only in the scenarios where you're really pessimistic about climate policy, where you're basically saying, I don't know, Donald Trump is re-elected in 2024 and he convinces Europe and China to abandon their net zero targets. Or, populists kind of take over the world and they don't care about climate. If we backslide in that kind of way, then kind of climate enhanced portfolios will underperform. But in the wide range of other scenarios, even scenarios where we don't achieve our kind of Paris goals, but we come reasonably close. So we're in a kind of 2 to 2.5 degree world. adopting a climate tilt now will help portfolios. There are possibilities in the future where that isn't the case. If we were to have a green bubble, for example, that may not be the case.
But as things stand, I mean, that's kind of fascinating. 11 out of the 14 scenarios that you found opportunities for outperformance in those kind of more the greener kind of space, which is just, I mean, a really positive note, I think, to end on as well. I'm afraid we've just run out of time, but I think that's been a really useful way to understand exactly how these climate scenarios, which can seem maybe a little bit abstract, really can be incorporated into the investment decisions that you make, particularly for you in that kind of long-term investment space. So thank you so much, Craig, and Jeremy as well, for joining us today. I think it's been absolutely fascinating. Thank you to everyone who's tuning in every week. And next week, we hope you'll join us again, where we're going to be talking about digital and innovation with Felicity Birch from the CBI and with James McCann, our US economist. And in the meantime, take care.
This podcast is provided for general information only and assumes a certain level of knowledge of financial markets. It is provided for information purposes only and should not be considered as an offer, investment recommendation, or solicitation to deal in any of the investments or products mentioned herein, and does not constitute investment research. The views in this podcast are those of the contributors at the time of publication and do not necessarily reflect those of Aberdeen Standard Investments. The value of investments and the income from them can go down as well as up, and investors may get back less than the amount invested. Past performance is not a guide to future returns. Return projections are estimates and provide no guarantee of future results.